A US company adopts artificial intelligence to protect margin. The first pilot looks clean. A support queue moves faster. A billing review takes fewer hours. A research task that once needed 3 people now needs 1 analyst checking the output. For a quarter, the story appears disciplined. Then the margin begins to move differently than the slide predicted. The company has not found false efficiency. It has found that the first visible saving was only one layer of the economics. The labor cost was easy to remove from the model. The new operating burden was slower to appear. This is the common margin illusion in early AI adoption. The business measures the cost that disappears before it measures the cost structure that replaces it. That distinction matters because early adoption happens under pressure. Finance teams are asked to show operating leverage. Product teams defend budgets. Service teams do more without proportional headcount. AI enters this environment as a margin story before it becomes a stable operating system. The first number is attractive because it is incomplete. A simple margin stack explains the illusion. Revenue sits at the top. Below it is the old direct cost, labor hours, vendor processing, manual review, service capacity. AI removes part of that layer. Beneath the removed cost sits a new layer: inference usage, integration, oversight, data cleanup, monitoring, vendor dependency, and exception handling. Margin improves only if the new layer remains smaller than the layer it replaced. The illusion appears when the old cost is subtracted immediately and the new layer is counted later. In a pilot, that delay can be large. Employees absorb supervision informally. Engineering connects systems without full allocation. Quality issues are reviewed manually but not charged to the workflow. Vendor pricing may be temporary. The use case may be unusually clean, repetitive, and expensive. The pilot is not lying. It is protected. The first margin illusion is labor substitution without labor release. A workflow may need fewer manual hours, but the people attached to it are not always removed from the cost base. They are reassigned to review, escalation, exception handling, recovery, or training. The work changes shape before the expense disappears. A cost can leave the workflow without leaving the company. The second illusion is pilot margin mistaken for portfolio margin. Early use cases contain repetition, clear output standards, and visible manual burden. After they are automated, the next cases are more fragmented. They depend on older systems, inconsistent data, judgment-heavy exceptions, or customer-specific context. The average economics weaken as the company moves away from the cleanest cases. The economics that appeared in the first use case rarely travel intact to the second or third. The third illusion is gross margin expansion without competitive response. If AI lowers service cost, competitors may adopt similar systems. Procurement teams notice faster delivery. Customers expect more output, shorter turnaround, or lower pricing. In US markets where comparisons are fast and contract pressure is direct, a cost advantage can become a price concession. Margin gained through automation is fragile when customers can demand it back. This is the compression point. AI may reduce the cost of producing a unit of service, but durable margin exists only when 4 distinct conditions hold together. Removed labor must leave the cost base. The AI operating layer must stay contained. Exceptions cannot expand downstream review burden, and the company must keep enough pricing power to prevent the saving from being captured by the customer. The advantage is real only when those conditions survive contact with scale. Early adoption often fails to separate productivity from profitability. A team may process more work with the same headcount and call it margin improvement. But if the extra output is used to meet expectations, reduce backlog, offset churn risk, or defend contracts, the company may gain capacity without gaining profit. More output is not margin unless the business can monetize it or remove cost. This is why the measurement problem is economic. The company must determine where the old cost went, where the new cost landed, and who captures the benefit. A department may show improved unit economics because labor fell from its budget, while shared technology, infrastructure, data, security, and platform costs are absorbed by the enterprise balance sheet. The enterprise can lose margin while one department appears more efficient. Legacy systems intensify the distortion. Enterprises attach AI to old databases, fragmented workflows, custom software, and approval chains. Each connection adds maintenance. Each exception creates a review path. What looks variable at the surface can become fixed inside the operating model. Quarterly pressure adds another layer. A company may present AI adoption as structural operating leverage before the cost base has stabilized. Markets reward margin expansion. Investors reward efficiency narratives. Budget committees reward visible savings. The incentive is to recognize improvement before the burden has matured. A margin story becomes weakest when it is most convenient to tell. Sustainable margin improvement is observed after the pilot glow is gone. It shows up when review hours do not rise with inference volume, vendor cost stays predictable, integration maintenance stays contained, error recovery does not absorb the labor saved, and customers do not force the full saving into price. The economics hold only when the saving remains inside the company. The margin stack becomes useful again. Revenue still sits at the top. The removed direct cost still matters. But the new AI layer must be visible, allocated, and tested under normal demand. The question is not whether the workflow became faster. The question is whether the full stack became lighter after support, oversight, infrastructure, and market response were included. That is the difference between early efficiency and durable margin. AI adoption does not create margin when it removes labor from a slide. It creates margin when the replacement cost structure stays smaller, steadier, and less transferable to customers than the structure it displaced. This is where the measured margin improvement holds, and where the early accounting of it stops being reliable.